Again, my name is Geof Smith. I've been trading since somewhere around 1985. I've got a couple of degrees in engineering. Was a pipeline engineer for about 10 years. And my father went to the School of Hard Knocks and didn't want his two kids to have to do the same thing. So he actually took it upon himself to kind of teach us about the markets back in the 80s or the 80s. And he had a broker. His name was Tom Busby, who's the founder and CEO of DTI. And so he asked Tom if he'd kind of help him teach his kids how to trade. And so hence here I am. And I heard Morgan say that I was one of his mentors. Well, his dad was mine, so I guess it's kind of a family deal. But I was a pipeline engineer for about 10 years throughout the 90s, and throughout that time I was getting up about 3 o'clock in the morning trading the S&P futures up until the time I had to go to work. I'd work all day, get home in the evening time, go to bed, and kind of did that for a good while and got into trading stocks and options pretty heavily in the 90s. And by that time, the market had become a hobby of mine, so Tom started a school down here in 96, and in 2000 convinced me to stop designing literally engines and come down here and help him teach people how to trade in the markets. So I've been teaching and trading ever since. I've traded in just about every market there is, not every vehicle by any means. There are so many of them out there, you just can't trade them all. But I enjoy kind of trading multiple markets, hence our name, the Diversified Trading Institute. We are an educational facility. We have on-site and online classes. So if you were wanting to kind of learn a little bit more about the markets, a method of trading in any market, that's what we do. We do have our own software called our Roadmap software. It's based around our method, and it is an analytical tool for trading. And of course, we have daily and weekly continuing education for our students. So I want to kind of walk through our method just briefly so you can understand the charts that I'll be kind of looking at and some of the color of the bars and things of this sort. And I want to kind of talk about a futures trade at 8:30, and then I'll kind of talk about a way of trading stock with options and things of this sort as well. And in fact, just a few minutes ago, I was listening to John, and I agree with him 100%. There's one constant in the market: it's time. Time is very, very important in the market because markets open and close at the same times every day. But not only here in the United States, but we also have opens and closes around the world. So we actually have a 24-hour market these days. You go back 15, 20 years ago, and most people just kind of focused on what the U.S. did. If you were in the U.S. market, whatever part of the world you were in, that's kind of where the focus was. But nowadays, everything is so intertwined that one small country overseas can put ripples across markets around the world. So we start watching markets from the time really New Zealand opens, which is the first market to open around the world, all the way up until we close out, which we're the last market to close around the world here in the United States. And that is really our 24-hour market. We've divided up the market in really 4 separate time segments, depending on who's controlling the market at the time. We have the Asian markets in our evening here in the United States. So between 5 p.m. Central Time up until about 3:30 in the morning, Asia is kind of controlling things. However, Europe opens up at 2 o'clock in the morning Central Time. The thing is, though, they have a lot of economic news that come up between 3 and 4 o'clock in the morning. So we like to get past their economic news because what's news? It's market food, right? So if we have no good news, markets should be higher. Bad news, markets should be lower. And so we want to get past their economic news to see what their trend's going to be coming out of Europe. And of course, from there, we have that European time segment from about 3:30 in the morning up until 8:30 in the morning Central Time when we open up here in the United States. And then we'll have our morning segment here, and we'll see that between 8:30 and 12:30. Basically, the first 2 hours of our market here in the U.S., we still have Europe open and trading with us. So we have 2 parts of the world trading. Once we get past 10:30 in the morning Central Time, Europe closes out. We go to lunch, we come back, and it's just the Americas that are left. We have the North, Central, South American markets open and trading. And of course, we end out our 24-hour day. So in time, the U.S. is the last market to open, last market to close around the world. So in time. We're not the forefront of the market. We're actually at the very, very end. So each of these individual time segments, we will consider its own day trading. Just because Asia's up doesn't mean Europe will be. Just because Europe's up doesn't mean we will be. Everybody has their own economic newses, their own people flapping their gums and stuff like this that can move markets around. So we look at each one of these really as its own little trading day. So we really have 4 trading days inside of one trading day. Of course, now we can't stay up 24 hours a day, 5 days a week, but we can kind of pick and choose what time we want to trade. If you're an early morning person, or if you're someone who lives in some sort of foreign country around the world, it might be a better time for you, of course. So we can look to trade at various times throughout our 24-hour market, depending on what we look at. Inside of each of these time segments, we have something called a reference bar. It's a 30-minute bar. We use the first 30 minutes of each of those individual time segments for reference, basically an opening range, if you will. We start breaking above that opening range, the markets are stronger. We break below that opening range, markets are weaker. So depending on the time segment that we're in, we'll have a different reference bar. Reference bar 1 goes from 5 to 5:30, which is the first part of that Asian time segment. We have from 3:30 to 4 a.m., which is the first 30 minutes of the European time segment. We'll have the 8:30 to 9, which is the first 30 minutes of our markets here in the United States, and then 12:30 to 1, which is the first 30 minutes of that afternoon time segment, which takes us into the close. But we'll use these reference bars as a guide going through each of these individual time segments. Here's just a quick chart I chunked in here this morning. This is your reference bar 1, and I got a little dot around here somewhere, I'm pretty sure. Here we go. We've got this little dot right here. This is reference bar 1. This is your Asian markets, and then we come into reference bar 2. This is the European market. This is actually yesterday's markets. Well, here's our reference bar 3. We had a big leap up, and then kind of a pull back in our morning, and then of course reference bar 4, we just kind of chewed around coming into the close of the market. So we can kind of use these as kind of a guide throughout our 24-hour market to kind of help us determine really an answer to a question of long, short, or out. One thing that we look at here at DTI is not the closes of things. We look at opens. It's the beginning of the race. I don't know how many people have been able to start a race at the end. I've never been able to. And the thing is, the end, we already know who won. We already know if bears won or bulls won in this case. Being in the marketplace, you look at the close of last year. Well, okay, great. The bulls won last year, but what's happening this year? And so we can start going from opens to determine whether A, things are stronger or weaker, or B, whether we should be looking long or going short. All these prices here are up to date as of 8:30 this morning. We opened up this year at 1837.75 on the S&P futures. We watch the S&P futures, not necessarily to trade them, though you can, but they are part of that 24-hour market. It's a derivative of the S&P 500 cash index. The problem is that they turned the index off at 3 p.m. Central Time or 4 p.m. Eastern. And then they flip it back on 17 and a half hours later at 8:30 in the morning Central Time, and all of a sudden you've got this 17 and a half hour gap. Well, if you think about a 24-hour market, we're open up 6.5 hours out of a 24-hour day, so we're actually only open about 27% of the time compared to the rest of the world. So the world actually in time has a lot more influence in things, right? So we want to know how the world's valuing our stock. And if you think about an index is a basket of stocks. So if the stocks move inside the index should be moving around. Well, they trade our stock around the world, just like we can trade foreign stock here in the United States. They call them ADRs, American Depository Receipts, and we can trade Toyota Motors. We can trade potash. We can trade Adidas. There's various different foreign companies that we can trade on our exchange here. And if you actually turn on CNBC or Bloomberg or something along those lines, you can watch our stocks trading in Europe. Well, if our stocks are trading, then the indexes should be moving. However, they're turned off. And so you can't really tell what our indexes are doing. Well, with the S&P futures, we can find out very quickly. what stocks are doing around the world. The stocks are pushing higher or pushing lower, and we can start trying to figure out, A, where we're going to be at 8:30 in the morning, and B, what our tendency is going to be shortly thereafter. But we've opened up the year at 1837.75 on the S&P. We opened up this week, which was on Monday, at 1824, which is below the year open. We opened up the month, of course, well, it's the year open at 1837.75. Globex open, which is the 5 p.m. open of our 24-hour market. Globex is actually the mainframe computer system up at the CME, but that's what the S&P, Dow, and NASDAQ futures trade on, so we look at that open of our 24-hour market. So when we have that open, we've opened up at 1837. Notice it's very close to the year open. We went up to 1839 last night, turned back around, started kind of selling back off a little bit. However, during the Asian markets, we dipped down to that low down there at 1828.75 before actually going up to 1839. Yesterday, we had a high of 1834.75. We had a low down at 1825 quarter. And of course, this morning, at 8:30 this morning, we were at 1837.75. So you'll notice that the year open, the month open, the Globex open, and the current today market open is right around that year open. So if you're trying to think of a pivot number very quickly, as long as we're above that year open, year's up. Below that year open, year's down. And if you even look at any of those various opens there, we need to be above 1837 to have a more positive market. In other words, bulls in control. And below that 1837 area, well, bears are in control. We're currently trading right around 1832 on the S&P, so we're actually down from that 1837 about 5 points. So, but we use these opens to kind of help us answer a question. Of course, we want to see a nice trend. We like to see above the year open, month open, week open, day open for a good, strong bull market. And of course, below all those opens for a very, very strong bear market. Doesn't matter what direction the market goes, we just want to be on the right side. So when we start looking at all of these, we want to kind of compare the current price, and it's not just necessarily in the S&P futures. You can look at the Dow futures, you can look at IBM, you can look at Disney. It doesn't matter what you look at, it's the same thing. We want to look at how they're trading based off those opens. If you're thinking about your portfolio from last year coming into this year, it's nice to write down all those year opens on those, because as long as we stay above those year opens, then I can probably be feeling a whole lot better about staying along those stocks. But if I'm consistently over the next month to 2 months staying below that year open, we might be wanting to either start selling covered calls against our stocks, or maybe just getting out and trying to find something that's moving up. So so far this year, we've been really pretty much below the year open for the majority of the year. Of course, we've only been trading for 6-7 days here, so we got to give it a little more time to see if they're really trying to sell things off or not. We opened up last month in December at 1806. However, if we ever get below that 1806, basically they've erased all of December, if you think about it. So until we take out 1806, I wouldn't be too worried about the downside. We're going to have up and down days throughout a marketplace. So, but we want to kind of see where things are trading. Now, we do want to see what's going on as far as the global markets coming into each and every day. How are we trading off Globex open, but also off of those reference bar opens? We'll have reference bar 1, the Asian markets, Globex open. We'll have the European markets coming into our open here, and are we trading above both those opens? If we are, once we get to 8:30, the question is now, do we continue that trend the world has had, or do we reverse that trend and start pulling things back a little bit? You see a lot of gaps inside of the indexes, on the cash indexes, just because of the 17.5-hour gap. The thing is that they're actually traveling there, you just don't see it. Be the same thing as if you're in the passenger seat and somebody else is driving, I hope. But you fall asleep in Memphis and wake up in Oklahoma City traveling down I-40 and say, oh, look, I gapped. No, you didn't. You actually traveled that distance. You were just asleep the whole time. And it's the same thing in the market. They turn the cash index off, they turn it back on. You have a 17.5-hour time gap. that you can't see what's going on during that time. Hence, we do want to see how the futures are trading. And you probably heard people saying, no, the futures are pointing to a higher open, futures are pointing to a lower open, and that's exactly what they're looking at. They're looking at the S&P down, NASDAQ futures. So when we start coming into 8:30 each and every morning, and now that we get past all the little preliminary stuff, we can kind of get into the trading side of things. When we start coming into 8:30 in the morning, the one thing that we have to kind of be careful of is how many people out there have a computer, and how many people last night decided to get out of their Caterpillar and flip around and buy DuPont, get out of JP Morgan and and buy Disney. How many people decided to get out of these stocks and buy those stocks, or just get out of all their stocks, or just buy a whole bunch of stocks? And that's the one thing we don't know, is all those decisions being made and people placing all these orders while they're watching Duck Dynasty at night or whatever it is, and all of a sudden at 8:30 when we hear the ding 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 going off, we get all these flood of orders into the marketplace. Well, we don't know exactly what the market's going to do at that time. It's going to start jostling around. So what we like to do is give the market a good 5 to 7 minutes to filter out all of those trades that are coming through. You have a lot of people trying to pre-position themselves for this morning's open yesterday, and right when the open comes out, they'll be getting out of their trade, hoping that the global markets would push things higher, the global markets push things lower. So we have a kind of a big mess going on, especially in the first minute or two, and then things start to kind of chill out a little bit, and then they'll start to trend. So after about the first 5 to 7 minutes of the market, we'll start seeing a trend in the market. It might be up and it might be down, but that trend will usually last for somewhere around 10 minutes, maybe a little longer. You'll see kind of a push between about 8:37, 8:40 up to about 8:50, and then they'll correct things a little bit. Now you do have to remember this: we at times will have economic news coming out at 8:55 in the morning, right? We have the University of Michigan Consumer Sentiment coming out at that time. We have tons of news that comes out at 9 o'clock in the morning Central Time, 10 o'clock Eastern, at various times throughout the month. Once in a while we have once a month we have the Chicago PMI or whatever comes out at 8:45 in the morning. So when we have those newses that are coming out, we have to be very, very careful trading between 8:30 and 9 o'clock, just because, well, news is market food. News can reverse markets. News can accelerate markets. So we have to be very cautious about that. So one thing we always want to do each and every day is find out when economic news is coming out. And if we know when that's going to happen, we can eliminate that problem very, very quickly. You can go to Barron's website. You can look at their economic calendar. It's free. You don't have to pay for it. Check out when all of our little economic news comes out. You can use investing.com, Forex Factory, whichever you want to do. There's various places to find the economic news coming out today. The Forex Factory and the investing.com actually does global news, so you can look at the news coming out in all the countries around the world if you want to. I mean, if you think about it, every country has their own CPIs and PPIs and retail sales and treasury budgets and all that good stuff. So we do have to kind of watch, depending on when we're trading, when economic news is coming out. So to be aware of that. But once we kind of get past that jostle, then we can start kind of finding a trend. The big thing is watch the 8:30 opening price. The market's going to start using that 8:30 opening price to either hold support or resistance on, and they'll start trying to push off of that number, and it will hold support and resistance. Here's a kind of small looking on the screen here, but this is actually on Monday. This is a 5-minute chart. The chart in the upper left-hand corner here is the NASDAQ futures. The chart in the upper right-hand corner is the S&P. In the lower left, you have the Dow. And in the lower right, you have the Russell 2000. So these are 4 index futures. And you'll notice in the first 5 minutes, every one of them kind of just jumped up real quick and started pulling back down a little bit. That's why we need to get past that first 5 minutes or so. Notice the Russell here just started dumping off. But once we got past that 5-minute range, look at what they've done. The NASDAQ went from about 35.70 or 32 or something like that, all the way down to the 35.18 area. Literally in about 15, 20 minutes here. The S&P went from right around 1831 down to about 1823. The Dow dumped off about 60 points. The old Russell here gave up a good 10 points. So if we can start watching to see that first 5-minute range and then kind of wait to see if they break one way or the other, but notice they're all that horizontal blue line. That horizontal blue line is actually the 830 open. Our software actually paints a horizontal line at the opening of each of those 4 reference bars, so we can very quickly see where the opening of that time segment is. And after that first 5 minutes, once they start breaking this range, we can very quickly start seeing what the trend is. And of course, if we want to, in this case, get short, this is actually the short side of things, and I'll just kind of show you how the week's gone here. It has a nice little push down. If you go to Tuesday, dink, here we go. It is basically the opposite. Again, this is your NASDAQ, your S&P, your Dow, and your Russell. And notice again, there's your little 5-minute ranges. Everybody's now staying above open, and everyone takes off, and off they go to the races. So depending on what you prefer to trade, I prefer to trade the NASDAQ futures myself, but you can trade the Dow, the S&P, Russell, whichever one you want to jump into. But again, you've got that 5-minute range. Once they take out that 5-minute range, that's usually the direction they're going to push for at least the next 10, 15 minutes, and then they'll usually have a tendency to correct a little bit and then kind of take off. A day that is a little tougher to trade, there we go. This is yesterday. You've got that first 5-minute range here, and you'll notice it doesn't work 100% of the time, but look at this Russell here. Never got back above, I mean, it just dumped off and never would get back above open. The Dow tried, the NASDAQ tried, the S&P tried, but all of a sudden they really started pulling back down again. Now you notice the NASDAQ yesterday turned back around and took off, but everybody else, I mean, the Dow never got back above the open. The Russell finally did, but the Dow was quite weak. So you kind of had a divergent market yesterday, which you don't get a good, a good solid trend off of that. So yesterday was kind of a hard day to sit there and go, well, I'm going to try to buy this thing or sell this thing or something along those lines. You had one that was very, very strong. You had one that was very, very weak. So when you start seeing days like that, it's just kind of best to leave it alone. But you've got, up days, down days, and days that are kind of more difficult. So I'm not going to sit there and say it works every single day. It does not. There's no trade that works each and every time. If everything was 100%, we wouldn't be sitting here, right? So we do have to kind of, wade through the tougher days. But, you look at even a day like today, you had, that first 5-minute little jostle kind of whipping around on the old NASDAQ. And all of a sudden, we can now kind of see what the trend is. But it pushed down, kind of held a little bit, and now it's kind of dumped off a little more. Started up around 35.72, went down to about 35.50 on the NASDAQ this morning. But it was actually a downtrend after that first 5 minutes. They held the open pretty well, and they started kind of dipping down, but didn't move all that quickly. But with a little patience, kind of went on down. In fact, here, let me kind of just show you something here very quickly. Over here, let's show you this monitor. It should pop up here pretty quick. There we go. This is a 5-minute NASDAQ chart right here. This right there is the 8:30 open. We opened up here, and notice they, in that first 5 minutes, kind of jostled around, pushed down, went back up, re-challenged the open here, and then kind of sold off a little bit. But the overall trend was weaker. You had the S&P Dow, even the DAX, if you all follow the DAX at all of them weaker, and actually was a nice little trade to this short side. So that first 5 minutes is actually a cool little range to watch. If you like to trade stock, stocks kind of work the same way. We can kind of watch to see John was actually talking about Apple a little earlier. You can use kind of a 5-minute on Apple if you want to, if you're an Apple trader, and kind of use that same little picture as we kind of go through each of these markets. But it's a kind of sometimes can be a very, very quick trade. So if you're not one to trade very quickly, you probably don't want to do this. I try to get into this trade as early as possible and see if I can't hold on to it throughout the morning to kind of maximize things. I mean, if you think about this right here, if you're still short right now, you're up somewhere around 20 points on the NASDAQ, a little more than that. If you, just kind of shorted it below here somewhere, and you're probably in from somewhere around 68, 69. We're currently trading at 47, so you're up a good 20 points, which is about $400 a contract on the old NAS, and seeing what you can do. If you're, if you want to trade some other markets, probably do that as well. Like I said, I prefer to trade the NASDAQ at this time. So, but it's a nice little indication of what the market's trying to do coming into the day. If you kind of think about, once they get the wash out there at 8:30 to 8:35 of all the orders flooding into the marketplace, now all the traders out there in the world are going to have to make a decision of what direction they think they want the market to go. And they'll start showing their hand based off how they're trading based off that opening price. And if they can't get back above open, then odds are they're going to push back down. If they can't get below open on the other side of that, odds are they're going to try to push this thing up. So, but you will have days that you'll have the indexes actually divergent. Like yesterday, you had the Dow that was pretty weak. You had the NASDAQ that was very strong. So, I mean, which one do you short? Which makes it kind of for a tougher market when you kind of see something like that. But today, they're all in the same direction, just like you saw on Monday and Tuesday. You had kind of a transition day on Wednesday. Coming into Thursday, we have a nice little downtrend. And now we get to see if they're going to try to bounce from down here or continue to sell things off throughout the day. This is 8:30 Central Time, Jane. 8:30 Central Time. On what basis do you enter the trade? Pattern or bias? Well, what I'm looking for, just to, once we get past this first 5 minutes, I start watching to see that they usually try to re-challenge the open like we did right here. And you'll notice this is only a point higher. And the NASDAQ, it's $20 per point, so it's no big deal. Once they kind of perk back up, they've had more down. I mean, look at the length of the bar from open. You've got a shorter bar up than you do down below the open, the horizontal blue line. And in fact, let's just do this very quickly. Kind of give you a better picture of the horizontal blue line here. There we go. Here is your opening range there. This is your open here. You notice they came back down, touched the open, and then turned back around and sold back off. They never could take out this high. I would use this opening range, look to get short probably down in here somewhere, right around the 68, 67 area. Initially put my stop up here, which is going to be somewhere around a 5 to 6 point stop on the NASDAQ. And once they came back up to here and took out these lows, I'd probably move my stop from up here to above that high. And of course, they dipped off here and they just kind of kept selling off. Finally, they kind of settled out right here at 53. They went up, and when they took out those lows, you take your stop and you move it above that high. And now we've got another new low here. Odds are they'll try to bounce up somewhere in here, and if they can, fine. If not, then they take out this 45 area next. You might take your stop and put it above that high, just depending on what they're doing. So you can kind of start trailing on their little, swing highs in this case, if you will. They dipped down, swung up. They dipped down, they swung up, and now they're dipping back down again. So for those little swing highs, you can start moving your stop down. So, but that's correct. You can actually argue that point. you can actually use these buy and sell zones that are on the compass charts here inside of our software for entry. Really what we're looking for here is to get a penetration bar into the sell zone and then get one that exceeds the first penetration bar. So in this case, you'll notice this red arrow right here is actually for this bar here telling you that that's a confirmed sell. So if you actually got short in here, which you'll notice that was 10 points basically from where we shorted it up here. But if you shorted it here, you're still up a good 10 points on the trade. It's not a bad idea to use it. This is actually the compass charts were designed around stock, but you can use them on the futures as well. No problem at all. But every morning, if you're looking for something that you can try to get into a nice little trending trade throughout the morning, today's actually worked out quite well. Use that 5-minute opening range there and start seeing what they do. I don't know how the stocks did. Let's just NFLX. See what Netflix did here. Here's your first 5-minute range on Netflix. Notice it tried to push back up. It had a really hard time with that 45 yesterday. But once they kind of agreed with the indexes and started kind of dipping down here a little bit, look what Netflix did. They went back up, couldn't get back above open, and then they kind of died off. They went from 341 to 5, so that's a $6 move in a stock. That's not a real bad trade, even if you bought the 340 put. I mean, granted, it probably cost you about $7-8, but you'd be up a good $3 or $4 on it right now. So not a bad little trade if you want to do stocks or options. But they do have a tendency to work real well off that little 5-minute opening range coming into each and every day. Just make sure, and I always want to kind of reiterate this, just make sure all the markets are doing the same thing. One thing you don't want to do is get into one of those divergent days where you've got the Dow trying to sell off for whatever reason, and you got the S&P kind of hanging out, but the Nasdaq's rallying. If you got lucky, you bought the Nasdaq and you made money on it, but it might turn around very, very quickly on you if the S&P starts pulling down. Now you got the majority of the markets yanking lower, and it can end up making you have a red day instead of a green day. So watch out for that. The Zenfire failure, or traders moving to new provider. I have not heard about the Zenfire failure. I don't use Zenfire. I use either Knight or the Garwood Interactive Brokers platform to do my trading through. I use a trading platform called NinjaTrader, but it can hook up to various different brokerages, and that's what I use. So going back over to here, there we go. Start kind of talking a little bit about stock here. We've got about a little over 30 minutes, and this is probably going to take us a little bit. Again, let me kind of go through some preliminary things. For those of you, let me ask this question. Is there anyone in here who has not traded options before? Anyone? Just a quick little question there. Yes, yep. So there's quite a few who have not traded options. Okay, well that's cool. Well, let me ask this question. Of those of you who have not traded options, have you traded stock? Yes? Okay, cool. Well, one thing that I'm going to start getting into here, this is actually a stock trade, but we're going to use options, okay? And what I'm trying to do in using the options, I think options, and I'll get a lot of argument out of this, and I'm not here to brew up any controversy, I'll put it that way. I think options are a great tool. I don't use them as a trading vehicle. You'll find something very distinctive about many people. You have bulls and you have bears. And of course, people are very bullish and you have people who are very bearish. Always. There's no deviation from that. And I think the majority of the people are kind of in the middle of the road there where they think markets do go up and down and things of that sort. Well, stock traders and options traders are kind of like bulls and bears. It's rare that you'll meet an option trader that would even think about buying a stock. But it's kind of funny that stock traders wouldn't even touch an option, because why would you waste the money? So you kind of have a polarization there as well. So you have traders of options, you have traders of stock, you have traders of various things, and everybody has their own opinions of things. My opinion, trade everything. It doesn't really matter. As long as you're on the right side of it and it's paying you, why not trade it? But I like to use options as a tool. I think they're the world's best tools, especially with stock, but you can also use them with futures and things of this sort as well. But options are very, very, very good tools to use. So if you can get some basic understanding of options, I think it would help you out tremendously in your stock trading. Even if you're an option trader, you might think about trading a little stock, just because it can actually kind of pay you a little more than what the options do. But let me kind of go through a few things here. For those of you who don't know options very well, real quick course here. There are two types of options. And think about this. You need to kind of simplify things. John was actually saying the same thing, and again, I agree with him there as well. People try to overcomplicate the market really, really, really severely. And if you kind of think about everything in the market is in twos. I mean, two things, right? 1, 2. The market can either go up or down. Some people say, well, it goes sideways. Well, yeah, but it's still going up and down when it's going sideways. You can either buy or sell in the market. That's all you can do inside of the marketplace. People can argue, well, you can stay out. Well, that's not being in the market then. So you can only either go long or short. You can, market goes up or down. There's only two order types that you can use in the market, a market order or a limit order. Now you can put contingencies on those. You can put stop market orders or stop limit orders or anything like that, but it's still just a market order or a limit order. So if you can only buy and sell in a market, again, twos, then you're going to have two types of options. And remember, there's buyers and sellers, so one option is going to allow you to buy, and one option is going to allow you to sell. There it is. So just remember, everything's in twos when it comes to the market. So when we start looking at call options give the right to buy. Now, it's not an obligation to buy. You don't have to buy it, but if you purchase a call option, you have the right to buy a specific, stock in this case. We'll be talking about stocks here, at a specific price. And they call that price a strike price. That's where you strike the deal. And it's a contract between a buyer and a seller. So if you buy the right to buy something at a specific price, well, if you exercise your right, then you can purchase it. If you don't exercise your right, then the contract becomes null and void. So the seller of the option, however, is obligated to fulfill the transaction. So if you have the right to buy something and you exercise your right to buy, then they have to sell the stock to you. And that's the kind of the way it works. You have buyers and sellers. It's kind of an agreement or disagreement or an argument. A call option is you argue said stock's going to go up. And if you agree with that argument, then you buy the call. So you agree with that. But if you disagree with it, you sell it. And that's basically the way the agreement or disagreement works. So on call options, you purchase the right to buy a stock at a specific price. When buying the call option, of course, it gives the buyer the right to purchase the stock at the underlying security's strike price. And the buyer expects the underlying security to move higher. There it is. There's that argument. If you buy a call option, you want that stock to move up. So when selling a call option, however, you have two types of really kind of the selling. You have one that's called a covered call and one that's called a naked call. But the seller of the call option, means going short the call option, gives the right to buy to the buyer and therefore is obligated to fill that transaction. So if that person says, hey, I want to buy it, then you got to sell it to them. Well, the thing is, do you own the stock or not? Okay. If you own the stock to sell to that person that wants to buy it, then it's called a covered call. If you don't own that stock, it's called a naked call. So the covered call is you own the stock. You sell a higher call. Basically, you own the stock. Say you own, I don't know, we were looking at Netflix a little earlier. Say you bought the thing at, I don't know, at $3.40. And you can turn around and you can sell a $3.45 call against it. So if it goes above $3.45 and they call your stock away from you, Cool. You make $500 on the stock, plus when you sell something in the market, what happens? You bring money in, right? So you bring in the money that you brought in from selling the call, and you get the $500 that you had on the stock. So that's a covered call. If it gets called away, that's fine. You can always look to buy it again later. A naked call, on the other hand, is you don't own the stock. And if you go out there and sell that 345 call, you can end up short the stock above 345 or right at 345, which is the strike price. So the thing is that bad? I don't know. If you think the stock's going to go down, then selling a naked call against it isn't a bad thing. You want to be short the stock. You just want to be short the stock at a higher price. No difference than wanting to be long a stock at a lower price. So a lot of people are taught to buy and buy and buy in the marketplace. There's nothing wrong with going short and short and short. It's a vote. You can vote various ways in the United States, especially in politics, right? Why can't you vote in the market? You can vote that the market goes higher. You can vote that the market goes lower. And hence you can go long or you can go short in the market. So if you think something is going to go down, why not see if you can't sell a naked call and see if you can get short the stock? If not, you get to keep the premium, right? So there it is. Puts, on the other hand, give the right to sell. Calls give the right to buy. Puts give the right to sell. So you have the right to sell something. Now, a lot of people will buy puts on stocks that they own. Why? Because, well, they have insurance now. So options are really kind of insurance if you want to look at things. But you have puts that you can purchase that gives you the right to sell a stock at a specific price, which puts are really a cool thing to use, especially during earnings. If you have a stock like Apple or Amazon or something that's very volatile, those stocks can move a lot during their earnings. So if you own the thing, I'd probably go out and buy a put, because if it does dump off, at least you have a right to sell it at a specific price. Plus, you'll pick up a lot of premium off of the move in your put direction. So now you can make a decision: sell the put to somebody else at a higher price and hold on to the stock, or exercise your right and get rid of your stock at whatever price that was. So you do have a choice to make there. But it does give you the right to sell at a specific price, again, a strike price on it before a specified date. Now, when buying a put option, of course, the buyer has the right, not the obligation, to sell the security at that specific price. And, of course, we want the underlying security to move lower, or we're just using it for protection, and hopefully it doesn't move lower, and we'll just spend a little money just to make sure it doesn't go lower. When selling a put option, again, the seller is obligated to fulfill the transaction, but when they have the right to sell, that means you have to buy it back from them, right? So you can end up long the stock. So if you think about that, buying a call, you can argues that you want the stock to move higher. If you sell a call, you can end up short or get your stock called away, right? So it's the opposite of buying the call. Buying the call, you want it to go up. If you short the call, you want the thing to go down. Same thing with the put. If you buy a put, you want it to go down. If you sell a put, you want it to go up. So buying and selling is the total opposite, and not only in the marketplace, but actually in options as well. So, but there are covered puts and there are naked puts. Most people don't hear the term covered put just because they've been taught to always buy and buy and buy. But if you're short a stock, you can actually sell a put against it, just like you can buy stock and sell a call against it. You can short a stock, you can sell a put against it, and it's a covered put. If it gets below that, you buy it back, now you're flat. So there are covered puts and there are naked puts. And of course, the covered put is you're short the stock. You sell a lower put, you bring in the premium, it's called away, so be it. You made money on it. So a naked put, you're not short the stock. You'll bring in premium, but you do have to have the margin in your account, just like doing a naked call, to actually own the stock. Or the money. I use margin because most people have margin accounts, unless you have an IRA or something like that. It's just a cash account. But you can end up long the stock. So knowing that in itself, what we're wanting to do, if we're wanting to buy a stock, instead of just putting in a buy limit to buy the thing, why not go out and sell a put? You'll pull in premium off of that option, And if they don't go down and exercise you to get you long the stock, you get to keep the money. So we can put in a buy limit, if you will, that they pay you for. Remember, time is money, right? So why not sell a put instead of putting in a buy limit to see if you can't get long a stock at a specific price? And those of you who trade stocks but not options, this is actually a great way to kind of take advantage of options, using them as tools to see if you can't pull in a little extra money for buying your stock. Now, get into a little strategy here on a stock trade. First of all, we want to sell a naked put, just what I was saying. I want to buy a stock, so I'm going to sell a put at a price that I'm comfortable with owning the stock. Now I'm going to pull in that premium. I'm going to collect premium on that. Now, remember, you can end up long the stock, which is the goal of this, because I wanted to buy the stock at a specific price, right? That's the main thing about this strategy. I'm not just selling puts to pull in premium. This isn't just an options trade. This is, I'm going to use options to buy a stock. So I'm going to go out and sell a put to buy the stock. Now, if the stock is not assigned to me, in other words, it's not below my strike price, then I'm not going to end up long my stock. So I get to keep the premium though. So they're going to pay me to wait, and flat out, I get to keep the premium since they didn't exercise it, and I'm done. So I can go out and sell another put later on, or I can sell, they have weekly options now on specific stocks. Not all stocks have weekly options. So I can start doing this every week on a stock that has weekly options. Stocks that have monthly options, you can do it once a month on the stocks that have monthly options. So depending on the stock that you're trying to buy, they might have weekly options or monthly options. Some stocks don't have options at all. I myself do not like to trade stock that does not have options on them, just because, well, I can't maximize my gain and minimize my risk because of that. Okay. Is being called away the same as being assigned? No, when it's called away, they take stuff from you. When you're assigned, you get stuff. So two different terms there, DD. When you're assigned the stock, you have to purchase it, or if you're assigned the stock on a naked put, you have to purchase it. If it's called away from you, well, then you're basically selling it, if you will. So there's that. So anyway, again, on this trade, we're going to sell a naked put to end up long. Now, you can use the same strategy to the short side. You'll go out and sell a naked call, in this case, if you want to be short in the market. Not many people like to short the market very much. I prefer to short futures as opposed to short stock. Not to say that I won't short stock, but I'm more apt to buy stock. I'm more apt to sell a futures contract, or a shorter futures contract, or a commodity, or whatever it is. So, but if you're looking to buy a stock, go out and sell a naked put, and we'll see if we get assigned on expiration. And if we do, then if exercised, that means you sold the naked put, and I'll show you some examples here in just a few minutes, so just kind of bear with me just a minute. But once you get exercised, the one thing that I don't like to do is risk more than, and this is, and you'll understand my no more than $5.20 or 520 bucks on 100 shares on something in a few minutes. The thing is, strike prices, if you look at strike prices in general, and now they're starting to get really weird. You can actually do, like 77 and a quarter or whatever it is, but let's just kind of go back to normal stuff here. Most strike prices are, either every 10 bucks, every 5 bucks, or every $2.50, unless you have a stock that's below 50, then it's every dollar, right? And some of them above 50 are every dollar, depending on if it's an index, an ETF, or something like that. But in general, that's usually how you'll have it. Below 50 bucks, it's every dollar. Between 50 and 100, it's every $2.50. That's the difference between strike prices. Then above 100, it's every 5 bucks, and above 200, it's every 10 bucks. Most stocks still adhere to that, but there are some of them that are, I guess there's so much trading volume in them that they've started to make it to where you can basically create your own strike price from just about anywhere nowadays. But anyway, I don't like to risk more than 500 bucks, per 100 shares on any stock. Now, of course, a cheaper stock you don't have to risk $5. And that's why I say, or just below the next strike on the option. So if you have one that's, like a, I don't know, a $60 stock, you're going to have strike prices every $2.50. So risk below the next strike. From $60, you got $57.50. So put it below, be able to put your stop below that $57.50 area. These stocks have a tendency to settle at strike prices of those options. That's just what they have a tendency to do. And so I always try to put my stops on the other side of the next strike down, or risk no more than $500. Because if you get into a stock that has $10 strikes, I'm not going to risk over $1,000 on a stock. So that's why I say this 520, but I'll explain the 520 in just a few minutes. Now, remember you brought in premium on the put that you paid, right? So we brought in money off the put that we paid. If I get exercised, I'm going to flip around and put a stop in. Never trade without a stop, period. Okay? So I'm not going to put it any further back than about $5.20, and actually it's $5.11 if you want to get exact, and I'll show you why here in just a moment. Or on the other side of the next strike. Now, I'm going to flip around and I'm going to sell a covered call against it. Remember, now I own the stock. So I'm going to flip around and sell a covered call against it. And I might, depending on how much premium I can pull in, I might go 2 strikes out. If not, then I'll go 1 strike. Some stocks, 2 strikes out's $5, right? Some stocks, 2 strikes out's $10. And of course, if you get above, if you get the real expensive ones, this could be like $20 or something like that. But you might not be able to get anything for it, so you might just go down to 1 strikeout. So if you bought a stock at like $480, you'd probably sell the $490 call. Granted, very expensive stock, but just giving you an example there, that's basically what you'd be doing. So I'd probably use a 1 strike on a real expensive stock, or see if I can't go 2 strikes, depending on the volatility of the stock. In other words, how much it moves around in a day. You might be able to get some money for the 2 strikes out, but you still might have to go 1 strike out. But I'm going to go out and sell a covered call against it. So with the premium I brought in off the naked put and the premium I've brought in off the covered call, I should be able to finance my stops here. And if not, then I might risk no more than about $100 on the thing. And that's what I'm trying to do. Even on a very expensive stock, you can actually get to where your risk is 0, that if you do get stopped out, you can make money just because of the options. Or at worst case, you might lose $100. So you can actually get into a scenario that if you lose money on the stock, you can still make money just because of the options you traded. Or you might end up losing $100 or so. Okay? So profit, you'll get the premium from the naked put, premium from the covered call, and the difference between where you entered and the covered call, if you will. So you can go back to here very quickly. On the risk side, if we can finance everything by the naked put and naked call that we sold, and we get stopped out, we might break even, lose a little bit, $100 or so, or maybe even make a little money and say, well, I tried and it didn't work. On the profit side, though, you get to keep the premium from the naked put, you get to keep the premium from the covered call, and you get the difference between where you entered and where you exited, or where you entered and where the covered call was called away from you. So if you're looking at a stock that, again, it's a very expensive stock, just like that 480 stock. Say we sold the 480 put and brought in $3 for it, and just to, I need to be able to write somewhere something. Well, just say we brought in $3.80 for it, and then they exercised you, and you flipped around and sold a call a month out $10 higher for like $5. Well, you pulled in $8.50 off the covered call and the put. Well, if I put my stop $5 back, if I go down out, I won't be able to keep that whole $5, but it'll at least get cut in half. So I can pull in about $500 off of those 2 options, get stopped out, don't lose anything. But if it turns around and goes higher, then they can call away my stock $10 higher, and I get to keep the premium. So I can take a $1,000 stock trade, turn it into $1,800, or at worst case, just break even. So that's kind of hard to do, Jas, with the the arbitrage between the stocks and the futures. Problem is your stocks, you can't do anything with them throughout the night market. The futures markets can move a lot at night. So between the stocks and futures, probably not the wisest thing to do unless you're using a contrary ETF. You might be able to do something like that, but arbitrage-wise, I don't think that'll work out too well. So one thing I want to kind of show you here, how much time we got? 15 minutes, good. I like trading a stock called AZO AutoZone. Go back over to here very quickly. It's kind of an expensive stock. I'm not going to disagree with that. And it doesn't have weekly options. But this is a daily chart on AutoZone. This is AZO daily. And you can kind of see, and I've chunked a couple of moving averages on here. These are simple moving averages if you want to know what they are. This is a 3-period average. This is a 21-period average. This is a 60, there we go, 5-period average, okay? And you'll notice it's riding pretty well right on that 21-period average. I just want to make sure that the short-term average is staying above that. Of course, the 65-period average is a kind of a long-term average. Especially if you throw this on a weekly chart, you'll see a whole lot different 321.65. I look at a 65-week average on a weekly, very, very long-term, right? But anyway, this is just a daily chart, and you kind of see this stock is trending higher. They went up, they pulled back, bounced off this 21 period, and now they're kind of bouncing back up. Yeah, price line's not a bad one either. Very, very good. Like I said, you can do this with any stock. It works out very, very, very well. So what I like to do, and let me, oops, I didn't mean to get rid of y'all. There we go. Let me pull an option chain. Unlock. There we go. Pull an option chain over here, so y'all can see an option chain. And I got ACO in here somewhere. Yeah, there it is. This is Interactive Brokers Trader Workstation if you're trying to figure out what this is. This is the option trader window. It might be a little different than the trading platform that you're using or whatever it is. But just to kind of go through things here a little bit. We're currently trading at 489. So they've had a nice little run the past 2 days. Earlier this week, it was actually a decent little trade, but you'll get the major gist here. So right now, if you're looking at this, notice this stock here, January 17, February 21, March 21. This only has monthly options. There's no weekly options in this. So do beware of that. So right now, since expiration is literally almost 1 week away, things are going to kind of deteriorate a little bit here. But let's look at this 480 put here. Here's your puts. Here's your calls. Okay. And right now we're about 170 by 2. So let's just kind of split this in half here and say we sell this thing for somewhere around $1.85. Okay. This was trading up around $3. But don't worry about that right now. We'll just use what we got. So we could sell this thing and bring in $185. Now I wouldn't do more than one. It's a very expensive stock. Now, who wants to put up 48 grand for a stock? If you got a margin account, it's 24,000. But anyway, we could sell this thing for $1.85, and all we have to do is wait until January 17th to see if we get exercised. If we don't get exercised, we keep the $185 and we're done. And then we go out to the next month and we try to do it again. You notice the 480s for next month here are right here, right around the $6 or $7 area. So, and I like doing this stock about 3 weeks, 2 to 3 weeks out from expiration, and you'll usually pull in somewhere between $4 to $5 for the option. Okay, which if you remember my, hey, I don't like to risk more than $500 on a stock. Well, I try to finance it just with that put. Now, you can't do that with every one of them, but we'll go look at a different one here in a little bit. So we're going to bring in 185 bucks, and all we have to do is wait until next week and see if we get exercise. If we don't get exercise, we keep the 185. If I do get exercise, remember this is the 480 strike. If we do get exercised, then I got the $185, but I'm immediately going to go in, and remember I was not going to risk more than $520 on a stock, right? Well, I'm going to put my stop at 474.89. What I'm trying to do is get off the fives and zeros. Don't put your stop at 75. Don't put your stop at 70. 470, 475, 480. Get off the fives and the zeros on the stock. So I'm going to put my stop just below that 75 area. That's why I say don't risk more than 520 bucks, because this is actually 511. So I'm going to put my stop back to 474.89 and immediately flip around and sell a 490 call as well. Now you'll notice the 490 calls here currently, now this is going into February. We still have a week here, so this is going to deteriorate a little bit. Well, actually, we're at 490, so let's go out to 500. Here we go. That looks a little better. Here's the 500 calls. The only reason why I'm using the 500s here, remember, we're getting long from 480. The only reason why I'm using the 500s because from the current price right here, plus $10 is right around 500, right? So if I look at the 500, that's basically what the 490 is going to look like if we're down at 480 next week. That's all I'm doing here. So we're probably going to pull in somewhere around $5. So I pulled in the $1.85 from the put, okay? Plus I'm going to get about $5 for the call I'm going to sell. So I'm going to pull in a total of about $685 on the call and the put, all right? So I've used them both. I think both of them have their pros and cons. My opinion, I think trading in IB is easier than Thinkorswim. I think the actual clicking and trading and stuff like that's kind of clunky and toss. I'd rather trade in this, but Thinkorswim has some pretty good cool tools in them as far as the predictabilities and all that good stuff, and you can kind of simulate your trade on these little things, and it'll tell you where your max loss is and max minimum, your max loss, max gain, min loss, min gain. And they have some pretty cool little tools in there and stuff like that. I think both of them have pros and cons, but as far as just actually literally trading something, I think IB is easier to trade through. That's just me. That is my opinion and my opinion only. You're going to have people disagree with me, but you asked me the question, so I'm giving you my answer. So there it is. So now I pull in the $685. Could you do no, hold on, Jess. I'm trying to buy the stock. I don't want to do spreads here. That costs me money. It reduces what I can bring in. So I don't care about spreads in this case. My goal is to acquire this stock and own this stock. That's the total purpose of doing this. Okay, so this isn't sell a spread and see if I can collect the premium and call it good. But I'm just going to sell a put, take it, and I'm going to sell a call against it once exercised. So that's what I'm doing. But anyway, so I can bring in a total of $685. Now remember, my stop is at 474.89, right? So if it comes down and stops me out down here, we're going to look at worst case here. It comes down and stops me out, so I lose 511 bucks, right? Minus 511. That's the difference between the 480 strike and my stop. The difference between here is $5.11, so I'm going to lose $511. See that? I brought in $685. So I'm not hurt in this case. However, once I get stopped out, I have to, I remember I sold a call against it. Now I have a naked call. So I'm going to have to buy that call back. Well, if we drop down, odds are this $5 is going to go down to around 250 somewhere. Okay. So I'm going to pull in somewhere around, what would that be? $435, right? After everything's said and done. So I have $435 once I buy it back. I lost $511. So my net loss here is somewhere around 80 bucks. So I lost 80 bucks on a stock that I lost $500 on just because of the options. But if we turn things back around a little bit, let's look at max profit. I pulled in $685 off the options, right? If the stock goes up to $490, I'll pull in $1,000 off the stock. So I have $1,000 on the stock plus the $685. So risk reward, I can make $1,685 and risk 80. What's the risk reward? Everybody's all uppity about risk reward ratios. How's that one? About 20 to 1. Yeah. So options allow you to maximize your gain but minimize the loss. Okay? That's the whole goal behind it all. You want to enter the stock on selling the put, buy the put, flip around, sell a call against it, and see if they'll call it away. Even if you do it on a, I don't know, I'm throwing a Dow stock in here. This is Disney. And this has weekly options, so you might be able to go out a couple of weeks here. We'll be trading on Disney, right around 75 bucks. So let's go to the, I don't know, 70, 50s. See, they started doing all these little 50-cent jobs here on these things now. We're currently trading here, so let's just say we want to buy this thing at 73. We'll go out an extra week here, and we'll get like 50 cents for it, or 55 if you split this thing. So if we bring in 55 cents, and if you look at Disney, let's just look at that very, very quickly off this chart we had here. New symbol, new chart, DIS.D. There we go. You notice Disney's been a nice little uptrend, pulling back a little bit though, isn't it? But again, if you want to kind of see how it's bouncing around, there you go. That's well above that 21 period average. So in that 21 period average is right here around 73.5. So let's see if we can't buy this thing around 73 or so. We'd have to risk basically below. If you really wanted to risk something, you had to risk down to 79. So you're gonna have to risk 400 bucks on it. But we'll play with the little options here a little bit, see what we can do. So we're bringing in somewhere around 55 cents on this thing. I need my little tool. Here we go. So we're bringing in 55 cents. So I just got 55 cents. This is just on one little contract. And then we see if we get exercised. If it drops down to 73, which is $1.65 from here, and the exercises in a couple of weeks, then we can go out. We're currently at 75. See if we can't sell the 75. That would be one further week out. The 75 call is going to bring us in somewhere around 75 cents. So if we get exercise, so we're going to pull in somewhere around $1.30 on the options. And if I can finance back to 70, let's just put it at $69.99, $69.99 here. Okay, so we're going to lose basically 300 bucks, 300 or 89. Sorry, my fault. $311 is what we're going to lose. We brought in 130, so max loss is going to be somewhere around 70 bucks, $180, something like that. Max loss, and max gain. If we flip around, we can make 300 plus the $1.30 that we brought in, which is $4.30. So I'm risking 180 to make 430. I still got better than a 2-to-1 risk-reward ratio on that one. And that's on a real cheap stock just using weekly options. And of course, you can go out to the monthlies and you'll pull in a whole lot more. Kind of like that. We're really not doing apples and apples here just because they have weekly options. You get a little less because of the weekly options because of you have extra, less intrinsic value. But for the most part, you end up doing that very, very well. So, looks like I have 40 seconds left. Is that right? I guess it is. So, real quickly, any questions? Since I have like 40 seconds left here. Sorry about that. I was going to leave a little time for a few more questions and things of that sort. Did not do so. But anyway, there it is. So very quickly, let me go back over here real fast. If you want to come to our webinar, we're going to have a webinar on Saturday morning at 9 a.m. There's it's basically techniques to determine the trend for the month. Go there to register. Thank you, Morgan, for popping that in there for me. And but if you want to kind of tune in, it'll be about an hour long or so. You can go there and register for that webinar, and we'll be more than happy to have you in. So thank you all for having me in. Thank you to the TradingPub for letting me present to you all. You all have a great and wonderful day, and good luck trading.
All right, great. Thank you, Geof. Appreciate you being here, and awesome job as usual. I know that Geof's one of those guys that's real big on education and not real big on fluff, so that's always a plus. And here's a link for kind of a follow-up presentation on determining the how to pick the trend for the month. So Geof, thanks again for being here and your analysis, and especially that last bit you did on AZO will be interesting to keep an eye on. So